So let's analyze the report provided by Edelweiss Mutual Fund. Starting with equity flows. India was the only emerging market to attract foreign portfolio investors inflows in April 2025. Brazil is the only country to record positive net FPI flows so far in the calendar year 2025. Domestic institutional investors have maintained a dominant presence in India's equity markets throughout calendar year 2025. The trends in commodity market. Over the past year, gold has consistently outperformed silver across all time frames. Crude oil prices have declined by 28% over last year, largely driven by geopolitical tensions stemming from Russia-Ukraine war. Within the base metal segment, zinc has recorded the steepest decline over the past year, as you can see. Now, the trends in forex market. Indian rupee has exhibited some strength against US dollar over the past 3 months. Over the last year, Japanese yen and Swiss franc have shown have shown strongest gains relative to US dollar. If we track the 10-year GSEC yield, the current YTM for India shows 6.36%, while for US it shows 4.16%. While tracking India's yield curve, the gap between 3-month and 30-year paper rose to 88 basis point as on 30th April compared to 58 basis point as on 28th March 2025. Improvement in liquidity conditions and RBI's hinting of further soft policy regime going forward has contributed to the rising spread. Now, if we look at gold versus equity, the ratio is 0.81 below the long-term average of 0.96, indicating that gold is slightly overvalued compared to equities based on historical trends. Its chart also shows that when the ratio is low, equities tend to stage a comeback. Now, if we compare gold versus silver, historically such elevated levels in the ratio have often signaled silver being undervalued relative to gold and have preceded periods of outperformance by silver. In simple terms, silver currently looks cheap compared to gold, making it an active contrarian investment opportunity. Then, what does the MOVE index tell us? The increase in bond volatility, MOVE index is the Merrill Lynch option volatility estimate. So, increase in bond volatility as measured by this Merrill Lynch option volatility estimate index often precede or coincide with declines in S&P 500. Historically, the correlation between the Merrill Lynch option volatility estimate index and S&P 500 has been 0.35. The MOVE index has experienced a sharp spike since mid-March 2025. Now going over the economy. The RBI delivers a dovish race cut. The Monetary Policy Committee voted 6-0 to cut the repo rate by 25 basis points to 6% for a policy stance change to accommodative from neutral. The FY26 average inflation is expected to weaken to 4% in the previous projection of 4.2%. FY26 GDP growth is projected to be 6.5% from previous GDP growth prediction of 6.7%. The RBI has promised to keep providing markets with durable liquidity. The banking system liquidity improves. The banking liquidity turns surplus since the start of financial year 2026, supported by RBI's OMO purchases. The measures taken by RBI to boost banking liquidity are the huge OMO purchases which they have done of buckets of 20,000 crore, which they bought 3 times, dated 8th April, 22nd April, and 29th April 2025, while a 40,000 crore OMO purchase was done by RBI on 17th April 2025. The RBI has decided to conduct this OMO purchase auctions of Government of India securities for an aggregate amount of 1,25,000 crore in 4 tranches, which I just said, in the month of May 2025 to boost liquidity. As one can see, the debt market indicators, as the banking liquidity turned surplus, it aided the transmission of monetary policy and contributed to yield softening. The key macro indicators also are in green, such as CPI inflation, crude Indian basket, GST collection, forex reserve, trade balance, bank credit of industry, bank credit of services, bank credit of retail, manufacturing PMI, services PMI. India is in a capex upcycle. India's capex cycle is now clearly visible, more led to capex upcycle before we touch the peak of previous peak of financial year '08, which can be seen from gross fixed capital formation as percentage of GDP. If we see this graph, the FY 2008 had the max peak of 36, while the FI current FY 24 is close in line with 31. Strengthening security. India's defense capex. India has substantially ramped up its capital expenditure in defense sector since 2021, driven by rising geopolitical tensions. Central banks with the largest gold reserves. Russia and China have acquired gold at fastest pace over the last decade, with Turkey ranking third, adding around 479 tons. The USA has the largest gold reserves, but hasn't added any gold since past decade. One fifth of gold ever mined is held by central banks worldwide. Central banks are rapidly boosting gold reserves due to rising geopolitical tensions and economic uncertainties. The sectors which are to be impacted post India UK free trade agreement are the most which would be affected is electronic goods, textiles, petroleum products, where India exported goods to UK the most, while India imported goods from UK most in the sectors such as machinery, electronic goods, silver. These are the sectors which are expected to be impacted the most. 99% of Indian exports, including textiles, food, or toys, auto parts, chemicals, and jewelries, will face no import duty in the UK. UK exports will see an outright reduction of US $5.5 billion in custom duties, as India will reduce tariff on 90% of the tariff lines. India versus global economy, the GDP share. India is to surpass Japan as the fourth largest economy in 2025 with GDP of 4.187 US trillion dollars. While India has strong per capita GDP growth potential, well, India's GDP per capita is 2878 US dollars. So comparing India versus world, mortgage versus and non-mortgage debt as percentage of GDP, though India's non-mortgage credit is comparable to many peers, mortgage debt remains far lower. India versus world, global economic landscape. India has substantial market cap, significant GDP, and impressive GDP growth, as you can see from the chart below. Now talking about markets, India's so the financial year 25 expected market cap to GDP ratio is at 126, which is 6.6% down compared to the previous year. The large cap valuations are above its long-term average, while the mid-cap valuations have dropped significantly from their peak but have remained above historical averages of 20 of PE of 24, while small cap valuations have remained elevated. Sees Nifty 50 EPS growth is at 1336 and EPS growth percent is at 24%. The ROE is gradually improving of Nifty 50 companies. If we see sectoral valuation, the current P and the current P, the sectors with the greatest growth are auto sector, private sector, private bank sector, and PSU bank sector. These three sectors are projected to have good growth as the current levels are below 10-year averages. While of consumer sector, healthcare sector, infrastructure sector, metal sector, oil and gas sector, technology sector, capital goods sector, the current price to earnings is greater than the 10-year average ratios. If we see the ownership structure of Indian equities, the mutual fund ownership in Indian equities is at an all-time high at 10.9% in March 2025. The FIIs have reduced their position, dropping to 17.3% in March 25 from 18.2% in March 2023. The FPIs have increased their allocation to large caps. The FPIs have increased their portfolio allocation in large cap from 76.9% in June 2024 to 78% in March 2025. They have significantly decreased their allocation to small caps since December 2024, falling to 6.2% from 7.1%. If we see the analysis of sector-wise FPI holdings, the FPIs have turned net buyers for the first time in current year 2025 with inflows of $5.5 billion compared to outflows of $0.4 billion in March. The largest buying was in financials of $2.1 billion and telecom, followed by telecom and media of $0.6 billion, while the biggest selling was in IT of $1.8 billion, followed by metals and mining, autos and ancillaries, and construction material, each of $0.4 billion respectively. Further, the FBI inflows surged to $4.5 billion in the second half of April, the highest fortnightly buying in 12 months. The FBI, as we just saw, markets find a way to bounce back. How many times have market reacted next post 1 year post corrections? If we see that in the correction periods of March 2015 to September 2015, of 188 days of market correction, the Nifty total returns was negative 15.2% in those 188 days. While after 1 year, the post correction return of Nifty 50 was 17.97%. While in case of September 16 to December 16, 109 days of market correction, where the Nifty return was minus 11.5%, the 1 year post correction return was 32.24%. While in case of January 18 to March 18, 53 days of market correction of minus 9.85% market return, the 1 year post correction was 16.09%. In case of August 18 to October 18, the 59 days of market correction with minus 14.4% of market return, the 1 year post correction return was 17.52%. In case of the February 20 to March 2020, the COVID-19 crisis, the 40 days of market correction, where the market lost, the market return was minus 37.46%. The 1 year post correction return was 88.33%. After that, in case of the October 21 to December 21, 63 days of market correction, wherein the Nifty 50 total return was minus 9%, and the 1 year post correction was 9.97%. In case of the June 2022 to March 2022, the 49 days of market correction, the Nifty 50 total returns during that period was minus 13.18%, while the 1 year post correction return was 12.2%. In case of April 22 to June 22, of 74 days of market correction, in which the Nifty return was minus 14.8%, the 1 year post correction return was 24.44%. In case of the September 24 to April 25, the 127 days of market correction, where the total Nifty return was minus 10.07%, the current 1 year post correction is expected to be positive. As per the average of 88 days, the 88 days, the total market return is expected to lose of minus 14.64%. The 1 year post correction return is 27.85%. If you look at the large mid cap and small cap performance, in the 11 of the past 17 current years, mid cap and small caps have outperformed large caps. If we see the current year 2008, the large caps gave minus 53% return, while mid caps gave minus 64% return, while small caps gave minus 68% return. The year 2009, the large caps gave 84.8% return, while mid caps gave 113% return, while small caps gave 117% return. In the current year 2010, large caps gave 19.28% return, while mid caps gave 20% return, while small caps gave 17.63% return. In the current year 2011, large caps gave minus 24.93% return, while small mid caps gave minus 31% return, while small caps gave minus 35% return. In the current year 2012, the large caps gave 32.51% return, while mid caps gave 46.69% return, while small caps gave 40.39% return. In the current year 2013, the large caps gave 7.89% return, while mid caps gave minus 1.28% return, while small caps gave minus 6.44% return. In the current year 2014, large caps gave 34.88% return, while mid caps gave 62.67% return, while small caps gave 71.66% return. In current year 2015, the large caps gave a meager 1.26% return, while mid caps gave 9.7% return, while small caps gave 11.27% return. In the current year 2016, the large caps gave 5% return, while mid caps gave 6.53% return, while the small caps gave 1.39% return. In the current year 2017, the large caps gave 32.88% return, while mid caps gave 55.73% return, while small caps gave 58.47% return. In the current year 2018, the large caps gave 2.57% return, while mid caps gave minus 12.62% return, while small caps gave minus 26.15% return. In the current year 2019, the large caps gave 11.83% return, while mid caps gave 0.60% return, while small caps gave minus 7.26% return. In the current year 2020, the large caps gave 16.08% return, while mid caps gave 25.56% return, while small caps gave 26.46% return. In the current year 2021, the large caps gave 26.45% return, while mid caps gave 48.16% return, while small caps gave 63.34% return. In the current year 2022, the large caps gave 4.94% return, while mid caps gave 3.91% return, while small caps gave minus 2.64% return. In the current year 2023, the large caps gave 21.24% return, while mid caps gave 44.61% return, while small caps gave 49.09% return. The current year 2024, the large caps gave 12.95% return, while mid caps gave 24.46% return, while small caps gave 27.21% return. If we see the periods of drawdowns, in the current year 2008, the large cap had a maximum drawdown of minus 61.8%, while mid caps had maximum drawdown of 71.75%, while small caps had minus 72.8%. In the current year 2009, the large cap had minus 18.67%, while mid cap had minus 23.51%, while small cap had minus 24.84%. If we see outlook, India versus world, India has deep equity markets at low per capita. India scores quite high on quality of capital markets. India's equity markets are quite deep and diversified with reasonably good corporate governance standards and high quality regulatory architecture. This is well reflected in the market cap versus GDP vis-a-vis per capita income metric, wherein India clearly stands out. Despite low per capita income, the quality of institutions of governance of India has been much better than what would be the case in countries with similar income levels. There is significant headroom for equities to grow further. Although the share of equities as a percentage of household assets in India has increased by 3x over the last 10 years, there is still headroom of growth when compared to global peers. Retail investors now hold more of Indian markets than foreign institutional investors for the first time, as the retail shareholding is 18.2%, while FII shareholding in financial year 25 is 17.4%. If we see which country had the most impact on India during global crisis, US holds a lion's share of total FPIs in India. So that naturally boils down that US has the most impact on India during global crisis, with US has having 39.85% of top FPI share in India. Equity desk of Edelweiss Mutual Fund suggests some signs of rural recovery are now visible, which had been absent over the past 2 years. If rural engines begin to fire, this could suggest further boosting demand. There is a pickup in discretionary spending as the benefit of income tax cuts start to flow through. Government capital expenditure has returned, and the real estate cycle continues to gain momentum. Overall, credit growth is moderating due to certain regulatory interventions and concerns surrounding unsecured lending. On the external front, the situation remains comfortable, with the RBI continuing to maintain high levels of dollar reserves. The corporate sector has navigated the crisis well, with balance sheets now far stronger than in the past. Markets are expected to remain choppy due to heightened geopolitical tensions and inflationary concerns. However, do not confuse volatility with risk. Higher volatility can be a friend to longer term patient investors. At this stage, spreading out investments over time appear to be prudent strategy. The fixed income desk of Edelweiss Mutual Fund suggests global bond markets received some reprieve from tariff-related uncertainties after the US announced a 90-day pause, providing much needed time for countries to negotiate with US. Global central banks have responded differently to looming tariff regime, while Bank of England and ECB and Reserve Bank of Australia have cut rates to support economic growth, and the Fed has decided to remain on hold until there is greater clarity on US economy. India's macroeconomic landscape appears healthy. India's headline inflation is expected to slow to 3.3% year on year in May, driven by falling food prices. India's core inflation is projected to remain around 4% year on year, primarily due to rising gold prices. May GST collection surprised with upside of 12% year on year growth, suggesting underlying economic strength. India's GDP growth for Q4 FY25 is expected to be around 6.5% year on year. India's banking system liquidity has turned into surplus of $2 trillion after a gap of 6 months. The RBI has been central to this liquidity shift, conducting rupees 5.3 trillion of open market operation bond purchases through May 31, 2025. This sharp increase in banking system liquidity has had a significant positive impact on money market yield curve. The bond market expects the RBI to cut policy rate by at least 50 points in current year 2025, despite ongoing border tensions. The IGB yield curve has deepened recently, with long-term yields rising more than short-term yield amid risk aversion. However, we believe that this presents a compelling investment opportunity for investors with a holding period of more than of at least 6 months. The factor investing desk of Edelweiss Mutual Fund suggests the current environment favors value positioning given its strong relative earning stability and prevailing risk of macro backdrop. In the near term, market conditions warrant a defensive bias with a gradual shift back to cyclical exposure once earning momentum stabilizes. While short-term performance, 3 month and 6 month have been under pressure across most factors, the 12-month numbers paint a much brighter picture with a growth leading pack with a 13% return, followed by value 11.4% return and momentum of 9% return. This clearly suggests that market rewards fundamentals and earning visibility over time. The recovery trend suggests recent corrections could provide attractive entry points for long-term investors. Looking at forward estimates, two styles stand out with the rare combination of growth and value. The value style has low estimate price to earnings of 10.54x, a solid earnings compounded annual growth rate of 12%, and the lowest price equity growth ratio of 0.88, making it ideal for re-rating as interest rate expectations soften. The growth style, on the other hand, offers a 2 year EPS see a compounded annual growth rate of 23% with a price earnings growth rate of 1.45, balancing premium valuation with robust fundamental. The key takeaways are momentum and growth factors are already showing signs of resurgence in 12-month returns. Valuation research value style opens the door to mean reversion and defensive allocation. Sector resilience in financial services and healthcare acts as a pillar of strength across styles. With volatility comes opportunity, and smart allocation across factors may be differentiator going forward. Look at the India's consumption sector, USD 4.2 trillion consumer spending by 2030, up from USD 2.4 trillion in 2024. India has demographic advantage, rising income, urbanization, digital new age consumption, easy credit availability, premiumization. In the case of India's IT sector, the key drivers are India's industry is set to grow from USD 254 billion to USD 350 billion by 2026, contributing 10% of nation's GDP. Global spending has surpassed USD 200 billion dollars by 2025, and India's share hitting $5 billion in cloud services. There is reduced dependency on H-1B visas from 11% in FY15 to 3% in FY23. India's IT export revenue grew from 59 billion in US dollars in 2010 to 199 billion dollars in 2024, with an estimated 20% compounded annual growth rate to reach 600 billion dollars by 2030. The rise in India's global capability centers market is set to surpass $100 billion by 2030, with 2,500 centers and 4.5 million data professionals. In case of India's manufacturing sector, the policy push for self-reliance and local production, Make in India and Atmanirbhar Bharat. There are PLI schemes across 14 sectors incentivizing domestic manufacturing. There is China Plus One strategy and positive foreign domestic investment cues. Global supply chain diversification driving investment in India. India's positioning itself as a global manufacturing hub and boosting exports supported by trade agreements, which we can see from the recent India-UK FTA trade deal. India's capex cycle is in an uptrend. Further room for growth, capacity utilization in private sector is at 12-year high. India is poised to become a $10 trillion plus economy over the next decade, with manufacturing contributing to over 32% to incremental gross value added by 2034. In case of India's non-banking financial sector, non-financial sector, the key drivers are retail and consumer finance, supported by digital lending, niche product offerings, wider reach and multiple touch points, easing liquidity and falling interest rates, leading to credit growth, moderate but healthy credit growth in NBFCs. The other factors to watch out for are NBFC market share in overall credit system, including banks and housing finance corporations, stood at 19% in 2024. Capital positioning of non-banking financial corporations remain healthy with capital risk adequacy ratio of 26%, above the minimum requirement of 15%. The stress in non-banking financial sector corporation sector has been receded in the last few years, where NBFCs grew faster than banks in almost all segments of industry, retail loans, services, agri and allied sector services, MSME services. In case of India's real estate sector, the key drivers are urbanization and rising demand, housing affordability and rising income, government initiatives for infrastructural push, while key trends are increased demand for warehousing and data centers, lower interest rate expectations, foreign investment sustainability, and ESG projects. So all thanks to Edelweiss Mutual Fund for this report.